Thank you for joining us this Friday, the 19th of November. I'm Sophia, a market analyst with Bell Direct. This is your weekly market update. We'll cover what happened to CBA shares this week, the best and worst market performers, how China's share market is looking, as well as a look at the week ahead. But first, let's take a look at the economic data. This week, we received wage growth data represented by the wage price index, which shows us the change in hourly rates of pay. Wage growth grew 0.6% in the September quarter and 2.2% year on year, the strongest annual growth since March 2020, with professional services, construction and hospitality leading the gains. Meanwhile, private sector wages increased further, growing by 2.4% on a year ago. So wages have picked up back to pre-pandemic rates of growth. The figures were in line with consensus, however, were higher than the RBA expected for this period. In May, the RBA predicted wage levels at 1.5% for this period. However, wage growth is still short of the RBA's 3% target. In recent economic data, there has been a trend of forecasts missing market expectations. For example, unemployment has fallen quicker than expected, inflation has risen quicker, GDP has recovered faster than expected, and now wages have also had a faster recovery. With this in consideration, this week, Governor Philip Lowe stated that the latest data does not warrant a rate rise. Now moving to the market's performance this week. Monday to Thursday, the market has declined 0.9%. All but three sectors are in the green week to date. Information technology has advanced the most, followed by healthcare and then communication services. Meanwhile, the financials took a hit this week, falling 3.6%. The materials and energy are also in the red. Looking at this week's leaderboard, with the IT sector in the lead, software developer Appen APX topped the chart, gaining more than 12%. And NextDC, WiseTech and Technology One all made the leaderboard. Nickel Mines, NIC, gained over 9% as investors have been buying in since the company announced their Indonesian Angel Nickel project is well ahead of schedule. Production output is expected in the first quarter of next year, 3 months ahead of schedule. Following the update, Macquarie retained their neutral rating on NIC and raised earnings forecasts for 2022 and 2023. Macquarie says the retreat in spot coal and Indonesian thermal coal prices has reduced pressure on NIC's earnings outlook. However, prices can still constrain earnings momentum. Macquarie increased their price target by 10% to $1.10. Evolution Mining EVN also increased. The gold miner is buying the Ernest Henry mine from Glencore for $1 billion. The market had a positive reaction to the news, with EVN leading the ASX 200 yesterday. Meanwhile, Commonwealth Bank CBA suffered this week, falling 9.9%. On Wednesday, CBA had its worst day since March last year. The bank's September quarter trading update saw cash net profit of $2.2 billion, which was below market expectations. CBA has weighed down on the financial sector, with Westpac, NAB and ANZ also falling. So CommBank's trading update also showed the competitiveness of the current mortgage market. With the cash rate at 0.1%, the major banks are not making as much money as before from borrowing and mortgage margins. CBA's CFO has said that the low interest rates, the competition of the mortgage market and the move from variable to fixed home loan rates all weighed down on net interest margin. So brokers were disappointed in the bank's sharp fall in NIM, with Macquarie and Credit Suisse releasing an underperform rating on CBA and Citi a sell rating. And the highly traded stocks by Bell Direct clients this week included Fortescue Metals, FMG, QBE Insurance and Mesoblast MSB. Clients bought into CBA, Westpac, WBC and BHP, while took profits in Western Areas, WSA, Pilbara Minerals, PLS and Macquarie Group, MQG. Now in US markets, week to date, the S&P 500 and the Nasdaq have made gains and are still on track for a positive week, while the Dow Jones is lower. Company earnings continue to show strength and push the major averages higher, with earnings reports from the big retailers lifting stocks this week. Now, let's take a look at global stock market performance and touch base on what's happening in China. So shares in many of the world's largest economies are boasting double-digit returns since the beginning of the year. Within the latest year-to-date S&P Global Broad Market Index figures, the S&P Canada is sitting at the highest, up 30%, followed by the US and then Italy. Meanwhile, S&P China has fallen by 11% year-to-date. There is high dispersion in Chinese equities. The best sectors are energy and materials, up 32% and 19% respectively. However, 7 of the 11 sectors are in negative territory. Gains in raw materials are overshadowed by sharp declines in consumer discretionary and communication services. And of course, with the property market under pressure, with construction developer Evergrande facing repayment troubles recently, real estate is the worst performing sector so far, down 20% year to date. So last night, S&P Global Rating analysts reported that they still believe an Evergrande default is likely. So in its inability to sell new homes, its core business model is non-functioning. And lastly, economic data to look out for next week. On Tuesday, the flash PMI for manufacturing and services will be released, giving us an idea of economic trends in those industries. PMI reading above 50 exemplifies improving economic conditions. And for reference, flash PMI is an estimate based on most survey responses received within manufacturing and services industries. It provides us with an advance indication of the final PMI data, which will be released the week after next. The figures for new capital expenditure in Australia will be released on Thursday, and retail sales data will be released on Friday. And that's all for this week. I'm Sophia Mavridis with Bell Direct. Have a great day and a great weekend, and I'll see you next week.